Good day. I am now going to give you the first lesson of global finance with e-banking. So for this first lesson, we're going to discuss about the features of international finance, dimensions of international finance, and goals of international financial management. So for the objectives, at the end of this course, the students needs or be able to understand the need to study and understand international finance. It introduces students to fundamentals of business and finance in the global economy, demonstrate understanding of the global economy and international finance. So, international finance, finance in an international setting. Financial management is concerned with how optimally makes various corporate financial decisions, especially when such company is a multinational corporation or MNC. It should make decisions pertaining to investment, financing, dividend policy, and working capital management with a view to achieving set of given corporate objectives. Because of globalization, multinational corporations should make diverse strategies. It is important for a financial manager to fully understand vital international dimensions of financial management. You might wonder why you need to grab or understand how finance works in the international setting. In today's trend, globalization is what is in. And because of the presence of the internet, social media, and other social networking sites, we are bombarded with various information coming from what is happening in the global market of the economy of other countries. And you might ask, why is it that it is important for us in the Philippines to understand or to have knowledge on what is happening in other countries? This is because we are not only serving our country, or other countries are not only serving themselves. We have trades, we have businesses in businesses of other countries and businesses of our countries are engaging if they have imports and exports. So we need to understand this because what happens in our country and what happened to their country may affect our economy and may affect the financial decisions of businesses in our country, especially if they are multinational corporation. So next, currencies. In your previous finance subjects, you may have already identify and have knowledge what currency is. But for review, currency is a medium of exchange for goods and services. Everybody knows this, right? In short, it's money in the form of paper or coins, usually issued by a government and generally accepted at its face value as a method of payment. The, the money does not have value unless the government imposes law to say that 1,000 peso bill has value. But if the law does not give it or does not provide law that our currency have value, then it does not have any value. Please remember that. Currency is a generally accepted form of payment, usually issued by the government and circulated within its jurisdiction. The value of any currency fluctuates constantly in relation to other currency. That's why we have, if you are familiar with the currency exchange in the province, in Dumaguete, sometimes we see it along BPI or in Lee Plaza or Robinsons, there are currency exchange, right? So there is a relationship between our currency and other currencies in of other country. The currency exchange market exists as a means of profiting from those fluctuation. That's why there's a saying that if the dollar to peso is high, then the market of the Philippines is not doing well. If the exchange rate from $1 is equivalent to, let's just say, 100 peso, then it signifies that the market of the Philippines is not doing well. So many countries accept the US dollar for payment, while others peg their currency value directly to the US dollar. Our country actually pegged our currency to US dollar. So in addition, currency is the primary medium of exchange in the modern world. Before, it was bartering as means of trading goods and services. In the 21st century, a new form of currency has entered the vocabulary, and that is the virtual currencies, such as bitcoins. So it is not anymore the paper and coins that we often use, but this is the virtual currency called Bitcoin. Bitcoins have no physical existence or government backing and are traded and stored in electronic form. I hope you have already encountered this word, and if you have encountered this, delve into it more so that you will have an understanding of what virtual currency is, and then an example of it is Bitcoin. Because someday when you graduate, or perhaps now, you are engaging into trading using virtual currency. So what is currency trading? Currency trading is the exchange rate is the current value of any currency in exchange for another country. For instance, you exchange if you want to go to another country, let's say Hong Kong, and the Hong Kong currency is Hong Kong dollar. So you trade your peso to Hong Kong so that when you go to Hong Kong, you can buy or purchase or avail of services using the Hong Kong dollar, because you cannot use the Philippine peso in purchasing or availing of goods and services if you go to Hong Kong and use it. The same at the same time, um, in the Philippines, if foreigners goes or comes into our country, they have to exchange their currency to the local currency so that they can avail of goods and services. This rate, currency trading, this rate fluctuates constantly in response to economic and political events. You might wonder that there was a time when there is a problem between, I think that's way back 2012, 2013. There was a problem with US and China, US and Iran. During that time, the currency of Iran really went down. So it fluctuates. It depends on economic and political events. So political crisis also affects the the exchange rate of certain currency, our currency maybe, or other currencies for that matter. To continue, so that is the first feature of international finance. So the next feature is accounting rules. So, generally accepted accounting principle, or GAAP, are a set of rules that encompass the details, complexities, and legalities of businesses and corporate accounting. The Financial Accounting Standards Board, or we have also here BOA, Board of Accountants or Board of Accountancy, uses GAAP as the foundation for its comprehensive set of approved accounting methods and practices. And then the law requires businesses that releases financial statement to the or to release financial statement to the public. And companies that are publicly traded on stock exchange are in and indices to follow the GAAP guidelines. Remember this. Publicly traded companies we have in our country, the likes of SM, Robinson's Jollibee Food Corporation, they actually publish their financial statement on newspaper like Inquirer, Star, or perhaps Manila Bulletin because they are publicly traded, and this is required by the law that they should let the public know, or their stakeholders know what is happening with their business. So that's the second feature of international finance. The third feature is stakeholders. A stakeholder is a party that has an interest in a company and can either affect or be affected by the business. The primary stakeholders in a typical corporation are its investors, employees, customers, and suppliers. However, with the increasing attention or corporate social responsibility, this is one of your subject also, the concept has been extended to include the communities, government, trade association, because these also are being affected or can affect to your business in running your business. A stakeholder has a vested interest in a company and can either affect or be affected by a business operation and performance. Typical stakeholders, so the primary investors, employees, customers, suppliers, and because of corporate, they have communities, the governments, and trade association. And entity stakeholders can be both internal or external to the organization. So you can see on the right side of your screen the internal and external stakeholders. So the internal are the employees, managers, the owners or the investors. And of course, the external stakeholders are the suppliers, society, government, creditors, shareholders, and of course, the customers. And the fourth feature of international finance is legal framework. Legal framework are the platform rules, each contribution agreement, and each fund description that constitute a legal basis for the corporation. There are legal framework of different countries. So the legal framework of the Philippines may be this, the legal framework of businesses in certain countries are this. So if you are a multinational corporation and you are engaging business in other country, you have to understand the legal framework of that country. Not only understand but abide to its rules. Why? Because if you do not abide to the rules of the country where you are engaging in business, one way or another, you're going to face litigation. And litigations are very expensive. Depends on the country and what are the corresponding fines for it. So those are the features of international finance. So another feature of international finance is institutional framework. So there's a legal framework and there's institutional framework. Institutional framework, the system of formal laws, regulation, and procedures, and informal conventions, customs, and norms that shape socioeconomic activity and behavior. These are a set of several legal, economic, culture, and social variables that constitute a key feature of a geographic area and determine the actions of institutions, companies, and people in this location. Missing an N. So, what is the usual activity or the norm, or what is probably in our dialect, what is uso diha, or what is accepted in that in that socioeconomic, and how should company behave in a certain socioeconomic society. And of course, language. This is also important in trade and international finance. Language is a system of communication used by people living in a particular country. An important advantage in conducting business abroad, especially if you speak their language. So, of course, in the Philippines, we have Filipino as our language. However, we have more than 40 other dialects. But if you want to go to other places in our country, you have to speak in our national language to be understood. However, that is just in our country. However, if you're engaging business in other country, it is rather of a great advantage if you speak and understand their language, because when you understand their language, there will be no language barrier, because you easily understand. You don't need anyone to translate it for you. And then somehow the universally accepted language is English. That's why if you want to go to other countries, if you do not understand their language, you ask people who can speak English. And with that, transactions can be done. Lastly, I think this is the last, the features of international finance is taxation. Taxation, this is imposition of compulsory levies on individuals or entity by the government. Taxes are levied in almost every country of the world, primarily to raise revenue for government expenditures, although they serve other purposes as well. So of course, even if you are an owner or of a business here in the Philippines and also an owner of a business in other countries, you have to pay taxes. But the taxes are different in terms of value and percentage, because in the Philippines, the new taxation law, which was imposed during the current administration, is actually rather friendly compared to our taxation before. And that is also one um, move of the government to invite more investors in our country. By lowering the tax, it invites more multinational corporation to conduct business in our country. And of course, if you engage business in other country, you have also to pay the compulsory taxes that the government requires. So it depends on how much the corporate tax of that certain country. Other countries have huge corporate tax, while some have uh, just corporate tax or lesser corporate tax compared to the other. So now we go to the dimensions of international finance. I think there are only three, but anyways. The first is foreign exchange and political risk. If you engage business in another country, you have to expect political risk, because different countries have different sets of politics and politicking. At the same time, foreign exchange, because this is very volatile, like mentioned in the previous slides, it fluctuates, depends on the economic condition and the political condition of a certain country. So, foreign exchange risk, when firms and individuals are engaged in cross-border transaction, they are exposed to this risk, foreign exchange. Political risk, this ranges from unexpected changes in the tax rules. This also arises to a sovereign country can change the rules of the game, and the affected parties may not have effective recourse. So like I said, political changes, when the policies of that certain government changes, or there are political insecurities, then one way or another, it affects your business. So I'm giving you an example or a situation on foreign exchange risk. Suppose Mexico is a major export market for your company, and the Mexican peso depreciates drastically against the Philippine peso. What does this mean? This means that your product can be priced out in the Mexican market. Why? This is because of how it works or how the exchange rate happens. The Philippine peso may be lower compared to the Mexican peso. That is for uh, foreign exchange risk. For political risk, when a business engage in international transaction with various countries, they should be aware of the political condition in the country where they conduct the business. because this may affect their operation and sometimes causes loss. That's why you have to understand the foreign exchange and political situation of certain country. And then market imperfection. These are the various friction and impediments preventing markets from functioning perfectly. There is no perfect market. Why? Because the market is affected by various entities or forces that makes it imperfect. The government policies and regulation, the as of the moment, pandemic affects the market and how it works, the labor force, technology, capital, among others. So there are various frictions that prevents the market to function perfectly. But however, businesses are still doing their best in order to combat this or go along with it. And expanded opportunity cost. When first firms venture in the arena of global markets, they can benefit from this because firm can locate production in any country or region of the world to maximize their performance and raise funds in any capital market where the cost of capital is lowest. It is not only the company can gain from this, from expanded opportunity cost. Even individual investor can benefit from this. This definition I am showing you in this slide is more on the business. But what I'm going to add is that it's not only company, but also individual. Individual person can also benefit from expanded opportunity cost. How? How? Let's say you are an investor. You have lots of money. And you want to buy a stocks, corporate stocks, or invest in foreign exchange. You will not buy stocks in the Philippines, but buy stocks in another country where market is performing well. Actually, there are a lot of individual with excess finance that do not buy stocks in our country, but rather buy stocks in another country where the market is doing well. So the same with investing in foreign exchange. So the same with stocks, the same with foreign exchange or the exchange of money. You invest in dollars or euro or even pound because you believe this currency is performing well and that their economy is stable. So if you have, like I said, if you have lots of money and you want to invest in currency, you are going to let's just say as of the moment, $1 is equivalent to 45 peso. I believe it's 47, 48, but let's just settle for 45. This is just an example. Let's just say as of the moment, dollar to peso is 1 is to 45 peso. $1 is to 45 peso. You have extra cash that is just sitting in your bank account. So you buy, let's just say, $1 million because you have a lot of cash. $1 million. And then why you buy $1 million? Because you expect that after 1 year, or let's say after 6 months, the market of US will go well. And then after 6 months, what you speculate or what you forecast happens. You buy your dollar from 45 peso, and then after 6 months, it costs $1 is equivalent to 50 pesos already. Then you gain 5 peso in every dollar that you purchase. How much is that? If you calculate it, you're a millionaire already. So expanded opportunity cost does not only benefit the business, the corporation, but also the individuals who are investors. So I hope you understand that. So next, what is the goal of international finance? We're almost done, guys. Don't worry. Shareholder wealth maximization. This is not only the goal of the international finance, but actually this is the goal of businesses to maximize the wealth of its stockholders or the owners of the individual owner or the partner, if it is a partnership or if it is a sole proprietorship, the owner of that business. So shareholder wealth maximization. This means that the firm makes all business decisions and investment with an eye toward making the owner of the firm better off financially than they were before. So, if their wealth previous year is 100 and this year it will be 200. So that is um shareholder wealth maximization. Shareholder generally accepted as ultimate goal or shareholder maximization. This is the generally accepted as the ultimate goal of an, an organization, and this is accepted in Australia, Canada, UK, and US. However, in France and Germany, believes that overall welfare of the shareholder as the important as very is very important. That is for Germany and France. That is what they believe. In Japan, they strive to maximize market share rather than shareholder wealth. So that is also what they believe. So it depends upon the country or those people believe. But at the end of the day, wealth maximization is still the firms or make sure that this is the decisions of the firms are towards this. That's why they cannot just decide without clearly understanding what may happen to the company and to the shareholders of that company. Next is corporate governance. As I mentioned a while ago, this is as part of the stakeholders, the communities, and this is part of the corporate governance. Corporate governance is a system of rules, practices, and processes by which a firm is directed and controlled. Corporate governance essentially involves balancing the interests of a company's many stakeholders, such as such as shareholders, senior management executives, customer, suppliers, financiers, the government, and of course the community. Corporate governance is the structure of rules, practices, and processes used to direct and manage a company. A company's board of directors is the primary force influencing corporate governance. So as you can see in the lower part of your screen, there's a house there where corporate governance is the roof. The goal of corporate governance is transparency of operation. There are no lewd or hocus pocus in their transaction. Accountability towards shareholders. So whatever decisions they made, they have to be accountable to the shareholder because at the end of the day, the shareholders are the owners of the company. And of course, fairness in dealings with their internal and external customers. And of course, all of their shareholders. A company cannot start a company cannot stay in business and maximize profit if it treats its employees poorly, produces poor quality merchandise, or fails to satisfy customer. At the same time, manipulate or evade tax. That's why there are various companies that face litigations because of illegal practices and and not taking good care of their employees and the community where they are conducting their business. So the goal of international finance and financial management is to, of course, even if they want to maximize the shareholders wealth, they need not or they don't or they have to also make sure that they are governing well and that they are taking care of the community and the various stakeholders where in the community where they are conducting business. So corporate governance continue. So bad corporate governance can cast doubt on a company's operation and its ultimate profitability. If the community or the customers or people knows that your company is not doing what it should supposed to do, like giving quality products one way or another, the people will the people prospective customers, consumers, will doubt you. And if they start to doubt you, they will have second thoughts in being loyal to our company or even purchasing your product. They rather go to another business where where they can get what they need. Corporate governance entails the areas of environmental awareness, ethical behavior, corporate strategy, compensation, and risk management. Environmental awareness. They have also to consider how, or if they are giving too much waste to the environment. That's why um, in highly industrialized countries or rich countries for that matter, they are very keen to this corporate governance, wherein they really are doing their best to to lessen their waste footprints of the planet. So technically, the basic principle of corporate governance is accountability, transparency, fairness, and responsibility. So I hope most and all businesses are doing this, not just to maximize their profit, but also doing corporate governance to have a sustainable business at the same time to sustain the earth. So these are the terms that you need to remember. Please don't forget. Globalization. In the is the word used to describe the growing interdependence of the world's economies, culture, and population brought about by cross-border trade in goods and services, technology, and the flow of investment. People and information, countries have built economic partnership to facilitate these movements over many centuries. So globalization, actually, in my own opinion, globalization already happened way back, even in the ancient times. Why? Because even without the word globalization, there is already trade happening in the world. In our country, there are fossils, there are remains, and there, like I said, there are fossils that have been dig up by archaeologists that signifies that there is a trade between Malaysia and the Philippines, China and the Philippines. And that is way back before the globalization word was being coined. And that who conquer us? The European, because they are looking for the Spice Island. So technically there was already trade happening between our country and other countries. It's just that it's way different compared now, because now we have sophisticated technology wherein globalization can happen even just over the internet, wherein exchange of goods and some services already happen in the internet. And we have airplanes, we have like we really have a lot of technology that has helped this globalization to be rather efficient. Next is trade liberalization. This is the removal or reduction of restriction or barriers on the free exchange of goods between nations. These barriers include tariffs, such as duties and surcharges, and non-tariff barriers, such as licensing rules and quotas. Economists often view the easing of or eradication of this restriction as a step to promote free trade. Free trade. And then trade liberalization removes or reduces barriers to trade among countries, such as tariffs and quotas. Having fewer barrier to trade reduces the cost of goods sold in importing countries. Trade liberalization can benefit stronger economies but put weaker ones at a greater disadvantage. So, what do you understand by this um, trade liberalization? Actually, this is actually happening now. However, if the economy is rather weak, and then liber- we put too much liberalization on trade, one way or another, our local produce will be taken out of the market. As you can see in the liquor area of a grocery store, there are stickers that means that this product has passed by custom. It passes to a legal legal process. If there are no, or that if the trade barriers is removed, our local wines and other liquor business may die because some imported products are less expensive compared to our products. I hope you understand that. The reason why the government imposes tariffs and trade, because this is also to protect the local product of a country. Like I said, if there is too much freedom in trade in terms of tariffs, duties, and surcharges, maybe small businesses in our country will die. And when it happens, it's going to be bad for our economy. Okay, hope you understand that. Next is economic integration. Economic integration is an arrangement among nations that typically includes the reduction or elimination of trade barriers and the coordination of monetary and fiscal policies. Economic integration aims to reduce costs for both consumers and producers and to increase trade between the countries involved in the agreement. Economic integration is different from what happened in the European Union. In the European Union, they only have one currency, that is the euro. In the economic integration, what happens in the ASEAN countries, or what is commonly known as the ASEAN integration, is actually economic integration. Um, this is this is the these are the common goal of economic reduction or elimination of trade barriers, and of course coordination in the fiscal policies. And then also, this is also to make way of sharing technologies. Imagine if we are integrated with, we have a good integration within the ASEAN integration. Um, it is easier for us to travel within the ASEAN country, the ASEAN country, ASEAN, ASEAN countries. And then when we are looking for job, and also they can share their technologies and knowledge to us. So this is also good. But somehow there are also a bit of barrier to this, because we need to be competitive graduates to be at par with the likes of Singapore, Malaysia. So we have to also be to equip ourselves so that we can be as competitive as they are. So ASEAN integration continues. When regional economies agrees on integration, trade barriers fall and economic and political coordination increases. Specialists in this area define 7 stages of economic integration: a preferential trading area, a free trade area, a custom union, a common market, an economic union, an economic and monetary union, a complete economic integration. The final stage represents a total harmonization of fiscal policy and complete monetary union. So that is on economic integration explained. Next is multinational corporation. A multinational corporation has facilities and other assets in at least one country other than its home country. A multinational company generally has offices and or factories in different countries and a centralized head office where they coordinate global management. These companies, also known as international, stateless, or transnational corporate organization, tend to have budget that exceed those of many small countries. Multinational corporations participate in business in two or more countries. MNC can have positive economic effect on the country where the business is taking place because it creates employment. Um, their their profit can be included in the GDP of that certain country, and the likes. Many believe that manufacturing outside of a certain country, some believe, has a negative effect on that certain country because it lowers job opportunities. Also, these are the beliefs. Um, they said also that transnational business is considered diversifying the investment. So how multi-corporation works? A multinational corporation or multinational enterprise is an international corporation that derives or at least a quarter of its revenues outside its home country. So they're not only focusing on profit within their domain country, but have profit outside the country. Many multinational enterprises are based in developed nation. Multinational advocates say that they create high-paying jobs and technologically advanced goods in countries that otherwise would not have access to such opportunity or goods. However, there are some critics of course. However, critics of these enterprises believed that corporations have undue political influence over governments, exploit developing nation, and create job losses in their own home country. So these are also the critics of multinational corporation. But if the negative effect or is lesser compared to the positive, then multinational corporation is good not only for its domain country but also to the country where they operate their business. So that will be all for the first lesson in global finance. Thank you and have a good day.